Welcome to Trading Nation. I'm Sara Eisen. Let's take a look at the so-called safety stocks that have been anything but this year. We're talking consumer staples, down over 12% in 2018. This as rates continue to rise. But one of your next guests says a bounce may be in store. Let's bring in the Trading Nation team. Gina Sanchez is with Chantico Global. Frank Cappelleri is with Instinet. So, Frank, what are you seeing in the charts of the consumer staples?
Sarah, as you know, it did get kind of hurt last week in a good amount. Now, if you look at that three-day move, it was about down 5%. We get one below March support. At the same time, if you take a look at the bottom panel of that chart, that has the RSI there, measures momentum. It did not hit oversold levels, at least as of yet, which is a complete difference to what we saw in February and March. So that's a minor positive divergence, which typically sets up a counter-trend move. So that's short term. Now, my bigger concern is longer term. And so we have now a chart that goes back to all the way to 2010. And we see that the consumer staples XLP is still in a rising environment there. But along the way, in the bottom panel, is just a rate of change on a weekly basis. And so before this year, there were 4 different times when we saw a weekly decline of 4% or more. That happened in 2011, 2013, 2015, and 2016. Now, those are harsh to sit through why they happened, but obviously they didn't alter the uptrend nature of the XLP. Now, that's a big difference to what happened recently. There's been now 3 different 4% weekly declines in 2 months. And so what that did, a number of things. One, it caused an uptrend to be violated, and we see a short-term, or I guess a small top on the top of that chart there too. And also consider this, we hadn't had a cluster of weakness that tight since the 08, 09 lows. So if you're a short-term trader, I think you can set up for a bounce. Longer term is going to be difficult to trust it. I think there may be a change of character afoot.
Gina, it's a group that has struggled to grow the top line. It's been appealing in a low interest rate environment. It's also been heavy in terms of M&A and activist targets. What do you think of the group overall at this point?
Well, I mean, I think you hit the nail on the head. When there's a low interest environment, you have really solid groups like consumer staples. They're great because they're dividend payers, because you can depend on people wanting to eat, drink, smoke. All of those things are all lumped in that category. However, you have, I think, a few things. One is we are now in a meaningful uptrend in terms of interest rates. And I think that's just going to be a huge headwind for this entire sector. So looking at it on a go-forward basis, you sort of have to consider that that dynamic has fundamentally changed. And what's really dragging it down right now really is Philip Morris and Altria. And the fundamentals for that sector just don't look that great. And so I think that's sort of a 1-2 punch for the sector. You might have some short-term bounces, as Frank suggested, but I think the longer term is going to be a lot more challenged.
Especially if we see those rates continue to rise. Guys, thank you. Gina and Frank, excuse me. And thank you for watching Trading Nation. I'm Sara Eisen. We'll see you next time.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.